Hi, and welcome to the Stockscores Market Minutes for March 4th, 2013. This week's topic, the preservation of capital. Reminder to subscribe to this YouTube channel. You'll get instant updates anytime I upload a new video. And also to subscribe to my free weekly newsletter at the address on screen, stockscores.com/newsletters.asp. The trader's number one goal is to preserve capital. If you don't have money to trade with, you are out of business. Many investors take way too many risks in the attempt to extract a great return, and when conditions are not favorable, they get wiped out. Most stocks and markets, most of the time, are not worth trading. Now we want to focus on the hot stocks and hot markets and avoid pessimistic markets. Avoid big losses, never average down, and don't take too much risk. Now I'm going to show you in a moment some charts where it's easy to demonstrate how to avoid pessimism. In terms of avoiding big losses, we never want to let that small loss grow into a big loss. And so every time you take a position, it's important to know where your exit door is and know what your risk tolerance is. If the stock falls below that risk tolerance, it's time to hit the eject button and get out. That way you won't have large losses in your portfolio that outweigh the gains that you're able to extract. It's also important to never average down. If a stock trade isn't working, why buy more of it? If you were at a horse race and your horse was in last place, you probably wouldn't wager more on that horse. If you've got a losing stock, then your analysis is wrong and something about that company is wrong. And it's important to never average down. You're better to just simply sell the stock, and if the conditions improve in the future, buy it back again. And it may be that you're buying that stock back at a lower price. And finally, don't take too much risk. Everyone has a tolerance for risk. You may be willing to lose $100 on a trade, $1,000 on a trade, $5,000 on a trade. Whatever your risk tolerance is the limit of risk that you should take on any one stock. Because if you take too much risk, well, then when it's time to take that loss because the market has proven you wrong, you're more likely to stick with that trade and let the small loss grow into a big one. All right, let's take a look at a market that is in a bearish trend and really is a market to be avoided. This is the TSX Venture Index, and if you've been reading my newsletter over the last, number of months, certainly, you'll know that I've been bearish on this market and have really found nothing to trade on the Canadian venture market. And you can see why. The tops are falling on this chart. The market is in a downward sloping channel. If you were to compare this to the S&P 500 or even the TSX Composite Index, you would know that this market is dramatically underperforming the global stock markets. And that's because it's heavily biased towards commodity stocks, and of course, commodity prices are not in a strong trend. Now, incidentally, this particular downward trend will probably bounce in the short term because it is at the bottom of that channel. But until this market starts to build optimism, starts to show rising bottoms, it is a market that should be avoided. Now we can say the same thing with stocks. If there are falling tops on the chart, as is the case with Yamana Gold, well, it's a market to be avoided. Don't hold on to stocks like this. If the story sounds great, if there are newsletter writers promoting the stock, if there are people in the media outlets promoting a stock, and then you go look at the chart and you see falling tops, well, it's best to simply avoid that stock until there starts to be some formation of rising bottoms. Now, I created the sentiment stock score to help you see stocks that are best to be avoided. If the sentiment stock score, and that's the green line on the bottom of the chart, if that sentiment stock score is below 60, you're best to simply avoid the stock, at least as a position trade. Now, day trades, we don't use the sentiment stock score, but if you are trading the market for the longer term trade, that is something more than 2 weeks, do not buy stocks that have sentiment stock scores below 60. You can see in the case of Yamana, that kept you out of the stock since the start of December when the stock first started forming its first falling top. And since then, this market has been falling quite sharply, and just using that one simple rule of sentiment stock score needs to be above 60, well, that one rule has kept you out of this terrible stock. All right, let's get into the normal market analysis. The S&P 500 has actually started to improve the last few days. It was in pullback mode, but it broke its pullback on Friday and followed through on that today, and it is now back towards testing that long-term resistance at the red line that you see on the chart. Now, I don't think the market is going to be able to break through that ceiling just yet. My expectation is we probably continue to stall here, but the pullback was really not as sharp as many people feared. The market held up well. The buyers came back and supported the market, and really in an environment where the U.S. Federal Reserve is printing money and stimulating the economy and the market with it, you have to say that the upward trend can probably last for a little while longer. Now, I'm not yet convinced that we should be ultra bullish just yet, but certainly the buyers remain in control of the U.S. stock market. The TSX is in a sideways trading range. It's really a tale of two markets in Canada. On one hand, you have the banks and the communication stocks, and on the other hand, you've got the commodity-based stocks. Gold is terrible, oil and gas not that great, and so as a result, you've got a market that's trending sideways. If you want to make money in this market, well, you got to look to those few sectors that are doing well and avoid the weak sectors like commodities and such. Russell 2000, which is an index of the smaller cap stocks in the U.S., has held its upward trend line after that pullback to it, and my expectation is it probably continues to hold that line. Now, if we break down through the green line on this chart, in other words, if we were to get a close down below $90 on the IWM, well, then you want to get a little bit more concerned. But for now, the upward trend remains intact, and so we can continue to be a buyer of U.S. small cap. The 20-year Treasury bond ETF TLT broke its short-term downward trend line, has not yet broken the longer-term downward trend line, and therefore I think you have to remain bearish in the long term, although you could see a little bit more of a rise here in the short term. For now, however, I think that Treasuries continue to be a place where money is coming out of, and it continues to likely land in the stock market, and that's a positive therefore for stocks. One of the real problems for commodities in the last couple of months has been the strength in the U.S. dollar. And that strength is probably a little bit overdone. We've been going straight up in the U.S. dollar for the last month. And I think that we could see a little bit of a pullback here. Really no sign of a pullback yet, except for the fact that the market's closed below its open the last 2 days. But certainly a pullback is overdue. You want to watch for that because it will be supportive for commodities in the short term. Now, while the U.S. dollar has been rising, the euro has been falling, and it's this euro chart that is really driving the weakness in the commodity sector because the U.S. dollar is getting strong. That makes commodity prices fall. Now, the euro has fallen away from its downward trend line, so therefore I wouldn't be surprised if we get a couple of up days in the euro, a couple of down days in the U.S. dollar, but that's still a short-term move. Until those trends are broken, don't get too bearish on the U.S. dollar or bullish on the euro. And here we have the chart of gold. Really, the selling a little bit overextended to the downside in the last month. And I think that if we do get a little bit of a pullback in the U.S. dollar in the short term, gold should bounce, hold that downward boundary on the downward sloping channel. I am by no means a bull on gold. I think that gold is in an ugly downward trend, but it is at the bottom of the channel. And you can see that on the other occasions that it was at the bottom of the channel in November and mid-December, it tended to bounce back. So don't be surprised if we see a little bit of a bounce back in gold in the short term. I think the key for that to happen is some weakness in the short term in the US dollar. Now, oil is also at support. I've drawn a pennant pattern in blue on this chart, and you can see that that downward boundary of the pennant has held up. We should get a bounce here. Again, critical that the US dollar is able to see some profit taking. But, you know, pessimism is so high in some of these commodities right now that that's often a sign that the shorts are going to come in and cover their positions and lead to a little bit of a bounce back. Does that mean I want to be a big buyer of these things? No, not yet. What it does mean is if you are short in oil stocks or short in gold stocks, you may want to look for some opportunity to take profits because a short-term bounce back is quite likely. And finally, the fear index, the VXX ETF, which is based on the VIX, of course, it remains in a downward trend. We've had some life in the last couple of weeks. You can see that volume has been quite a bit stronger lately, but it still hasn't broken that long-term downward trend, just as the stock market still hasn't broken its long-term upward trend. So this is something to watch, because certainly that little jump up in fear over the last 2 weeks is something to be concerned about. But it's really not a strong chart yet. We're not getting breaks from rising bottoms, and you can see the sentiment stock score on the VIX ETF is still well below 50, so there's no optimism there yet. All right, so my outlook, I'm upgrading my outlook on U.S. stocks from bearish to neutral because of that recent bounce back over the last couple of days. Neutral on Canadian stocks, kind of stuck in that sideways range, but the trend into that range is up, so we should see a breakout soon. Gold bearish, but as I said, due for a bounce. Oil bearish, but also due for a bounce. The US dollar is due for a pullback, which, if it happens, should be supportive for gold, oil, and other commodities. While a bounce back will be welcomed, commodity stock traders should not take this as a sign that these sectors have reverse sentiment. They have lots of work to do in order to do that. And as I said, stocks are stabilizing after a little bit of volatility and weakness the last 2 weeks, and they are starting to look better. Well, that has been the Stockscores Market Minutes for March 4th, 2013. Have a great week in the market and trade well.